Let us see the next question. An Indian exporter has an ongoing order from United States of America for 2000 pieces at a price of $100 per piece. To execute the order, the exporter has to import 6000 yen worth of the material per piece. Labor costs are rupees 350 per piece, while other variable overhead add up to rupees 700 per piece. The exchange rates are currently 71 rupees per dollar and 120 yen per dollar. Assuming that the order will be executed after 3 months and the payment is obtained immediately on the shipment of the goods. You are required to calculate the loss or gain due to transaction exposure if the exchange rates change to 74 rupees per dollar and 110 yen per dollar. That is the question. Everybody please go through the question, then we are discussing the concept. Let us have understanding of this question. To explain that, say we are taking the information provided to us. An example, we have been provided with the spot exchange rate information. Rupees per dollar is given and yen per dollar is given. Similarly, the exchange rates are provided to us, say, after 3 months. Now based on this, we can always make the computation that say what will be the exchange rate for, let us say, rupees per yen or yen per rupee, that we can calculate. So it is rupees per yen. Let us say that we are calculating. After making this calculation, I explain you the concept of the question. We want to know that what is the amount of the rupees for every 1 yen. Against yen, dollar is given, and against dollar, rupee is given. I want rupees per dollar, the same is given to us. I want dollar per yen, but yen per dollar is given, so we have to make it a reciprocal. So 1 divided by 120 into 1. So 71 upon 120, 0.5917. It is rupees per yen. Now similarly after 3 months, so this is 74 into 1 divided by 110 into 1, 0.6727. Friends, over here the question is providing the information that basically we are doing two transactions. One is that we import raw material, and for that we are required to make the payment in yen currency, and we are exporting goods, and for that we are going to receive the consideration in dollar currency. We can understand that if at all there is a situation that yen currency appreciates, that is the case over here, that is the kind of loss that we have. What happens that for the same yen we have to pay more amount of rupees, and if at all the dollar currency appreciates, then in that case it is favorable for us. So over here the dollar currency is appreciating, and that is like a favorable situation for us. So whatever this change in the foreign currency, and because of that you are able to increase your profit, or because of that your profit reduces, is given a name as the transaction exposure. Whenever you have the foreign exchange dealing, at that time you have three kinds of exposure. One is given a name as a transaction exposure. The second is say, given a name as translation exposure, or it is given a name as accounting exposure, and third is given a name as so the operating exposure. That is the way we have say these three kinds of exposures. One is the transaction, second is translation or accounting exposure, and third is given a name as the operating exposure. Over here we understand something like this. Listen carefully. The term translation exposure stands for whatever is the change in the value of the receivable, whatever is the change in the value of the payable. Because of that, say whatever the profit or loss that say comes to you, whatever the profit or loss that you have in your transaction is given a name as the transaction exposure. That is over here in this example. So the dollar currency appreciates and you have exported in that currency. You are going to receive consideration in that foreign currency. Then in that case, so that results into profit to you. The currency in which you are required to make payment is again appreciating. Then in that case, say it is a loss for you. So taking into account these two effects combined will make the computation of the profit or loss due to transaction exposure. That is another term called accounting exposure or translation exposure. With the name only you can understand that say whenever say there is a transaction like this, head office and branch office. If at all there is a company in let us say United States of America, and that company is having say the branch in UK, it is having say the branch in Germany, like that it is having say the branches at different places. When the consolidated financial statement is prepared, the branch office records or subsidiary records are incorporated in holding company. At that time, say there can be say the profit or loss due to exchange rate variation, and that is given a name as the translation or accounting exposure. In the financial management, basically, we are not too much concerned for this. So we do not give too much emphasis set to this exposure. But the operating exposure is the last one, in which say we understand something like this. We understand that say the valuation of a company can be done by a number of methods. Valuation is possible by using the net asset method. Valuation is possible by using the book value method. Valuation is possible by the earning capitalization method, and so the future cash flows method. So whatever the future cash flows that we are going to receive, that you are going to pay, all of them are considered say in valuation of the company right now. So if at all there is a company say which is having say the export exposure on the regular basis, and even in future it is expected that say the company is going to have the foreign currency receivable, then that foreign currency receivable will be converted into the domestic currency, and then it is converted into the present value term in order to compute the value of the company. If at all the company is importing goods, the same is the case if at all the payable is in foreign currency. If at all the company has taken a loan and it is going to make the repayment of the loan in foreign currency, then the same thing is applicable. What I want to tell you is that whatever the foreign currency receipt or foreign currency payment that you have, say is subject to the fluctuation. And because of that, whatever the current value of the firm is likely to change. It may change favorably or it may change unfavorably. Whatever this kind of change in the valuation of the company is given a name as a profit or loss due to operating exposure. This is the way, so we are having say the three kinds of exposure. In this question, we are going to understand profit or loss due to transaction exposure. Over here, we can see that so the information is given that 2000 number of units and $100 is the sale consideration. So 2000 into 100, that comes to the sales value of $2 lakh. Dollar currency is likely to appreciate from 71 to 74. So you are going to receive 3 rupees more. So into 3, so 6 lakh rupees is positive. You are going to make payment in the yen currency. How much? 6000 into number of pieces are 2000. So that comes to 120 lakhs. Yes, 120 lakhs. And we can see that as far as the yen currency is concerned, it appreciates with the difference of those two. So 0.6727 minus 0.5917, that comes to 0.081 multiplied with 120 lakhs. So there is a loss of 9,72,000. So on one hand you have a profit of appreciating the dollar currency, on the other hand you have a loss of the appreciation of the yen currency. Net of both of them is a profit or loss due to transaction exposure. This is what we understand. And in this question we are going to make that calculation. Please write on heading transaction exposure. In the write down first point, profit or loss due to transaction exposure means change in value of foreign currency receivable slash payable. Second point, in normal domestic trade, comma, due to credit offered to customers, comma, there is no change in value of receivable, full stop. At the same time, on purchasing goods on credit, comma, there is no change in amount payable in domestic transaction, full stop. With paragraph write down, however, in foreign currency transaction, comma, amount receivable slash payable is likely to change due to change in exchange rate. Full stop. This change is called profit or loss due to transaction exposure. Third point, accounting or translation exposure means at the time of incorporating branch records in head office, books of accounts, comma, there may be profit or loss due to change in exchange rate. Full stop. It is called profit or loss due to accounting exposure. Full stop. It will arise also in case of merging subsidiary records in holding full stop. In bracket write down, generally this type of exposure effect is ignored in financial management. Full stop. Fourth point, profit or loss due to Operating exposure means change in value of company, comma, due to foreign exchange rate fluctuation. Full stop. Valuation of the company is possible by a number of methods, comma, one of them is present value of future cash flows. Full stop. If at all foreign currency received or payment is included in such forecasting, comma, then there are chances of change in value of company due to change in forex rates, and with that forex cash flows. This change is called profit or loss due to operating exposure. Full stop. Now, first of all, we'll prepare a small working note for calculation of the exchange rate of the rupees per yen. We can even calculate the difference. That is, the yen per rupee is also fine. Read an answer. Working note number 1. Now the answer starts. Calculation of exchange rate for rupees per yen. We have been provided with the information about rupees per dollar rate and yen per dollar rate. So for rupees per yen, will form an equation. 1 yen is equal to how much rupees? Rupees is final answer. Answer is required per yen. Against yen, rupee is given, and against rupee, dollar is given. We'll do the calculation for spot rate and exchange rate after 3 months. That is the way we'll make the calculation for two rates. Okay. We can see that the spot exchange rate information is given as 71 rupees per dollar and 120 yen per dollar. I want a dollar per rupee, but rupees per dollar is given, so we have to make it a reciprocal. I want a rupees per yen. I'm sorry, there is a mistake on my end. Against yen dollar is given, and against dollar rupee is given. I want rupees per dollar, the same is given. In the equation, I want rupees per dollar, the same is given, so we don't have to change it. I want a dollar per yen, but yen per dollar is given. Answer is required per yen. So 71 upon 120, so 0.5917. It is rupees per yen. Next, after 3 months, it is 74 rupees per dollar and 110 yen per dollar. $74 into 1 divided by 110 into 1. So 0.6727. Rupees per year. Now friends, after making this calculation, as I had shown you the above working, in which you can make a comparison of the two exchange rates and you can determine the profit or loss. Or otherwise the institute is giving answer like this, which is also correct. Simply they make the computation of the profit or loss using the spot rate, and they make the computation of the profit or loss using the new spot rate. That's it. And difference of both of them is a profit or loss due to the transaction exposure. So they make working like this. Working note number 2, calculation of the profit or loss using spot exchange rate and using exchange rate after 3 months. So here column number 1 will be spot exchange rate, column number 2 will be exchange rate after 3 months, and over here particulars. So what we have to do, we have to consider the sales. How many number of units? We understand it's the 2000 number of units. What is the sale consideration? $100. What is the spot exchange rate? It is 71. Direct material cost. Again 2000 number of units. The price per unit is 6000 and spot exchange rate is 0.5917. Next, we have been provided with the information about the labor cost 350 and overhead cost 700. So other cost, it is 350 Yes, plus 700. Multiply with the number of units are 2000. That's it. So sales minus expenses, that will give us the profit or loss using the spot rates. Similarly, we will take the exchange rates after 3 months. So what will happen again over here? It is 2000 into 100 into 74. Next, it is 2000 into 6000 into exchange rate is 0.6727. Next is the overhead cost, that is going to remain same, and with that the profit or loss will be calculated. New profit minus existing profit. If at all there is an increase in the profit, then there is profit due to transaction exposure. If there is a reduction in the profit, then in that case loss due to transaction exposure. This is the way we are required to write the final answer. Please take down answer from working. So 2000 into 100 into 71, that comes to 142 lakhs. 2000 into 6000 into 0.5917, 71 lakh 400. 350 plus 700, 1050 into 2000, 21 lakhs. So 21 lakh, 71 lakh, 400 are deducted from 1 crore 42 lakhs. So there is a profit of 49 lakh 99,600. In the proposed one, 2000 into 100 into 74. So it is 1 crore 48 lakhs. Two thousand into 6000 into 0.6727. 80 lakh 72,400. This is going to remain same because it is in the domestic currency, 21 lakhs. So 1 crore 48 lakhs minus 80 lakh 72,400 minus 21 lakhs. So again there is a profit, however the profit has reduced, that it has reduced to 46 lakhs 27,600. So profit or loss due to transaction exposure. New profit minus existing profit. 46 lakhs 27,600 49 lakh 99,600. So reduction of the profit is loss. So there is a loss due to transaction exposure 3,72,000, and we already have discussed that earlier, that over here you are being benefited by 6 lakhs. However, 80,72400 minus 71 lakh 400. So over here the cost increases by 9,72,000. So this is the benefit and this is the loss. And because of that, so this amount of the loss is 3,72,000. If at all somebody is giving this presentation directly, that is also absolutely acceptable. Or going like this is very simple. You make the computation of the profit or loss with the present and with the new one. So the foreign currency in which you have imported, you have exported, that currency appreciates, depreciates, you don't have to think anything. Everything will be taken care by the profit or loss.